Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Dr. Jun-sok, Professor of Economics at the Catholic University of Korea. Professor Yang, good afternoon. Thank you for making time today.
Happy to be here.
Well, the U.S. markets were closed ahead of Easter for Good Friday. That was the case for a lot of markets. Some will even be closed on Monday, too. But this is going to be a big week for earnings. And, of course, investors watching for any comments from the Federal Reserve. Last week, stocks in the U.S. were down. What will you be watching this week in the global equity markets, Professor?
Okay, well, the U.S. markets will be open on Monday, but as you mentioned, on the last day of trading on Thursday, the markets fell back down in the U.S. It was attributed to mixed earnings results from major banks and fear of rising inflation, while bank earnings did mostly beat estimates and reported estimates. Earnings fell considerably compared to first quarter last year when banks had some extraordinarily earnings, which were not repeated this year. And also the inflation and U.S. commitment to raise interest rates are expected to reduce future earnings of banks and perhaps even drive U.S. to a recession, which accounts for the lackluster performance of bank stocks even after the reports came out. Now, how analysts and markets treat inflation, it seems to change day by day. One day they seem to be just ignoring it. Other days, the possibility of inflation makes market incredibly nervous. But last week, the markets were definitely hit by the consumer price index news. Consumer price index for March hit 8.5%, and then came the producers price index report on last Wednesday, which hit 11.2%, which was the biggest gain on record since U.S. started reporting the producers price index in 2010. Monthly increase was 1.4, and monthly increase in core producers price index was 0.9%. So the strong producers price index inflation means that the consumer price index inflation will continue to be high for the next few months. Analysts are now expecting Fed policy rate to hit 2.5% at the end of the year. So bond yields have gone up on Thursday and for the week. On Thursday, the benchmark 10-year U.S. Treasury rate rose to multi-year highs, climbing 13 basis points to 2.8%. For Thursday, Dow was down 0.3%, S&P by 1.2%, Nasdaq by minus 2.1%. For the week, S&P was down 2.1%, Nasdaq by 2.6%, and Dow by 0.8%. Europe, they were closed on Friday as well, but they did slightly better on Thursday. DAX, FTSE and CAC all went up, though less than 1%. Asia, well, the big news was that China's first quarter growth was 4.8%. They did beat the expectation of 4.4%, but there is more and more doubt whether China will be able to meet the government-set growth goal for this year, which is around 5.5%. And unemployment for 31 major cities is now 6%, which is highest on record going back to 2018. So Asian markets, Nikkei was down by about 1.1%, Shanghai down by about 0.5%, and Hang Seng was up by 0.7%.
Well, that data from China may have been playing into the situation here in Korea today, where stocks close lower today, and shares of cosmetics companies were actually outperforming today. You have to wonder if that has anything to do with the possible end of mask wearing in Korea in the next weeks or months. What's the story here in the domestic market?
Well, the story is while the distancing will be over starting today, more or less. The international situation is looking not as good as it did about a month ago, and that seems to be weighing down on the Korean stock market. Korea Exchange published a report on the 17th, and it reports that during the first 3.5 months of this year so far, foreigners sold on the net about 20.9 trillion won's worth of Korean financial assets. This includes 9.2 trillion won from Kospi, 2.5 trillion won from Kosdaq, and about 9.7 trillion won worth of futures contracts. Because of the possibility of rising U.S. interest rates as well as the nervousness in the global market, the foreigners are definitely withdrawing from the Korean markets, which accounts for not only for declining trend in the KOSPI and KOSPI, but also the depreciation trend of the Korean won. KOSPI was down today by 0.11%. It ended today at 2,693.14. Individual spot, institutions sold, and foreigners sold. Year to date, KOSPI is down by 9.9%. KOSDAQ was down 0.67%, ended today at 918.25. Individual spot, institutions and foreigners sold, and year to date, KOSDAQ is down 11.5%.
Well, speaking of the depreciating Korean won, we've now got a rising exchange rate, rising consumer prices, and rising interest rates. Some are saying that we might not make it to that 3% projection for economic growth this year. These things not necessarily conducive to that. What do you make of the situation, Professor?
Well, it will be difficult to meet the government goal of 3.1%. I personally think it'll be, if not impossible, very, very difficult. And that's because not only is Korean domestic economy weak, but also the foreign situation is looking worse. Now, because of the end of distancing, there might be hopefully some kind of a bounce back effect. But still, Korea is returning to the economy of 2019. And 2019 was frankly not a very good year for Korea. It had a relatively slow growth rate. It had lackluster exports. So it is returning to normal, but it's returning to a very slow normal of 2019. And that's probably going to affect how Korea does in the growth rate. Now, the bright spot for Korea was to be exports, and Korea has been hitting record monthly exports for the year so far. But if you look at the numbers, that is mostly because of the rise in prices rather than increase in volume. In fact, in March, the volume of exports only went up by 6%, even though the total value of exports went up by 18%, and that was because the prices rose by 22%. The problem is this rise in international prices, the global inflation, hits Korea positively with exports, but negatively for imports because Korean import value also goes up. And the problem is especially acute with oil. And when Korea imports oil, not only for making products for export, but also for domestic use. So if oil prices go up, well, for exporting oil-related goods, Korea can charge high prices for it, so it sort of nets itself out. But for domestic use, Korea has to pay the high prices of oil, and that's going to lead to more trade deficits for the near future. And whenever we have an increase in imports, well, mathematically, it doesn't necessarily mean this is bad, but mathematically, it does mean that the growth rate falls. So that makes achieving the 3% growth that much harder. So combined with slow domestic economy as well as the increasing trade deficit, it really seems very difficult to believe that we will have a 3.1% growth this year. I just want to remind the listeners that the potential growth rate for Korea is now estimated to be somewhere between 2 to 2.5%. So if Korea actually does somewhat better than 2.5%, then even though it may be a bit disappointing, I still think Korea is coming out ahead.
Right, have to consider that a win. We'll have to leave it there for today, Professor. Thank you, as always, for sharing your insights with us. We do appreciate it.
Thank you.